if you follow financial markets, which if you're watching this video, you probably do, you've probably been hearing a lot of talk about the bond market lately.
I believe that we've started a bond rally here.
And for how much longer will we see this bear steepening of the Treasury curve?
10-year U.S. Treasury note.
How high are we talking about, Jim?
And you probably noticed that bond yields have been moving higher, and you've probably been trying to understand why. In this video, I'm going to break down why bond yields have been moving higher and why they'll probably move even higher from here. Now, I should add, the bond market is extremely complex. It's very hard to predict, damn near impossible. So anytime you hear a bond market prediction, I guess any prediction is someone's best guess, but this is like the definition of a best guess. Now, let's jump right into it. Bonds can come in multiple forms, from mortgage bonds, municipal bonds, corporate bonds, and U.S. Treasuries. In this video, we're focusing on U.S. Treasuries. Now, each bond comes with its own maturity date. It also comes with a yield attached to it. A yield is essentially a return on your money. And bond investors essentially cross-reference that yield to the maturity date to determine if that investment is worth it for them or not. A U.S. Treasury is considered to be the safest investment, as you would assume that the U.S. government won't default on their debt. That's up for you to speculate on yourself. And so whenever you hear the term risk-free rate, investors are referring to the yield that they will receive from holding a short-term T-bill, which I should add, there's a difference between a Treasury bill, a Treasury note, and a Treasury bond. Bills are less than a year, notes are between a year and 10 years, and bonds are more long-term, so over the 10 year, so out to the 30 year. And another important aspect of the bond and bond yield relationship is that they're always inversely correlated, meaning that when bond prices move up, yields move down. And if bond prices move down, yields move up. So that's what I mean by inversely correlated. So remember, we're focusing on yields in this video. So what determines the yield on a bond? Well, like any other asset, it's determined primarily by supply and demand. But the supply and demand aspect of bonds are determined by a myriad of factors, from inflation, economic growth, as well as interest rates. Now, I want to move on to a huge reason why we got in this predicament in terms of bond market action. And that reason is the Federal Reserve. And I've talked about this on previous videos, but during the 2008 financial crisis, a big response by the Federal Reserve was quantitative easing, or debt monetization. And really a huge, like 95%, I don't know the exact percentage, but 95% of debt monetization is buying treasuries, buying government debt. And so in the ensuing years, the Federal Reserve proceeded to buy over $5 trillion in U.S. treasuries. And they're not able to hold on to these treasuries forever, as the Fed ends up in a position to where they end up operating at a loss. And that most of the treasuries that they bought over the previous decade, they carry a yield of 4% or less. But the federal funds rate, as we can see now, is at 5.25%. So if they're generating 4% or less on the assets that they hold on their balance sheet, and they have to pay out 5% on excess reserves to banks, and that's what the banks are lending back and forth to each other, well, the Federal Reserve, they're losing money. And the reason they bought bonds as a response is because interest rates were already relatively low. And so they didn't have much room to lower interest rates from where they were at the time. And the Federal Reserve directly affects the short end of the curve. And so as they went on the most rapid rate hike cycle in history, of course, short-term yields were soon to follow, which means that they knew that at some point they would be in this predicament in which they are operating at that loss. Now, why have yields gone up so much in the past year? So it's not one reason that yields have been moving up over the past 12 months or so, but there's a myriad of factors that go into it. Now, I think one of the main reasons yields have been moving higher is because, as I mentioned before, the Federal Reserve bought over $5 trillion of bonds over a decade. which yield less than 4%. And so it's been a mission to roll those bonds off of their balance sheet. And so as you can see, over the past 12 months, they've rolled off about $1 trillion in bonds, which means that there's more supply on the market. Now, in the face of steady demand or weakening demand, obviously that's going to push yields higher as more supply hits the market. The second reason is the Treasury refilling the Treasury account, which means they have to hold auctions or basically they have to sell those bonds to the open market. And so they hold auctions. And in the last auction for 30-year bonds, you can actually see the weakening demand for Treasuries. As you can see, the number of dealers that participated in those auctions as a purchaser of those bonds actually increased in the last 2 auctions. And when I say dealers, I basically mean investment banks or other large institutions. And also the weakening demand from foreign investors as purchasers in the bond market. And so once again, we have more supply, we have less demand, which means higher yields. Part of the weakness in the Treasury auction is the fact that a lot of investors are aware that the Federal Reserve, they have to offload these bonds from their books. They can't keep them forever and they can't keep operating at a loss. So we know we're going to see more supply in the near term and long term. It's going to take years to deplete their balance sheet of all those bonds. And so why would I lock in a rate today for 30 years or 10 years expecting that that rate is going to be higher, which means the value of the bond that I bought is going to be less. I'm going to lose money. Doesn't make any sense. And yeah, the third reason is just part of the fact that we've raised interest rates from essentially 0 to 5% in like 13 months. And remember I said that the Federal Reserve pretty much directly affects the short end of the curve, and the long end of the curve, yield wise, it follows short-term yields. And so as the short-term yields started to rise based on the Fed funds rate, longer-term yields have followed. Well, what's next for the bond market? Well, one would think that as yields move higher, bonds or treasuries will become more attractive to investors, which means as demand picks up for those treasuries, the yield should fall because the price or value of that treasury has risen in response to the increased demand. And so yields should fall again in that scenario. But because demand is relatively weak at the moment, we could see weaker bond results coming out of future auctions. And that's in addition to the Federal Reserve offloading those bonds from the balance sheet. And so that could push yields higher. Either way, one thing that is a fact, that everything that I just mentioned is essentially pulling liquidity out of the market. And it's another form of QT or quantitative tightening. And so liquidity should continue to dry up over the coming months. I am in the recession camp sometime next year. I don't know exactly when, so don't ask. And I think policy action has indicated that that is the goal, to get some regression in the markets, to have a return to some sense of normalcy. And when a recession hits is the only time I think the Federal Reserve will reverse course and start cutting rates. Even then, I don't think we'll go all the way back to the zero bound. So please don't expect that. But the point is, we're not there yet in the Federal Reserve's eyes. Although they've paused on raising interest rates and in the last few meetings, selling those treasuries and taking capital out of the market is another form of QT/quantitative tightening. By carrying out the selling of those bonds, the Federal Reserve is accomplishing their goals still by becoming more restrictive until they hit that point where they're sufficiently restricted. So yeah, guys, I hope I made the bond market action as of late make sense to you. If so, let me know in the comments. Give me a subscribe, like the video, and yeah, I'll see you on the next one.